story on every single newspaper is the boredom of a stock that everybody thought went bankrupt years ago. And it's just the meddlum behind something that's been going on generation after generation after generation. I've read lots of biographies about different top traders, and you go back to Joseph Kennedy, John F. Kennedy's father. In his biography, he talked about how he knew it was time to get out of the markets when his cab driver was giving him, it was his shoe shiner was giving him hints. Jesse Livermore, it was his cab driver. Later on, I think Michael Lewis said it was his secretary. And now I have clients that are basically saying, oh, my kid came down and asked to borrow $25 so he could buy GameStop stock. What do we have? A 30 or $35 billion valuation on something that the professionals all think is going to go bankrupt. And it probably should go bankrupt. It's a retail semblance. I don't think many people buy games anymore. They just download them. So it's a great nostalgic company, but I don't see people coming in to try to acquire blockbuster rights just because they nostalgically loved going to the movie store years ago. And it just becomes this interesting story of how the regulators are going to try to control and try to keep people from harming themselves. Because people should be able to trade freely. That's kind of like saying, well, everybody should wear a seatbelt in their car. But we should prevent somebody from hurting themselves and hurting others at the same time, which is people drinking and driving. That's what's going on here. When you pump up a stock that's completely worthless just to hurt somebody else, i.e. to hurt the hedge funds, all of a sudden you're doing damage to the people that are buying those and the hedge funds. Now, the hedge funds, they're professionals. They shouldn't have taken that much risk. For a top hedge fund to lose $2.5 billion in a day on a couple short positions, that tells me, those hedge funds weren't doing a really great job. But on the other side, it's those young guys that are jumping into a stock with no valuations, no homework, just on the pushes of what they're reading on the internet. That becomes what's called a pump and dump scheme. And a pump and dump scheme has been illegal since Joseph Kennedy, the first head of the SEC, made it illegal back in the, what was it, 1934, I think, when he passed the first laws of the SEC. You'll be able to tell me if I'm wrong on that historical date, but yeah. This is what led to the Great Depression, was lots of pooling. So I would expect the SEC to be all on top of this. We've already heard lots of members of Congress saying we have to get on top of this, and I agree with it. Because that can lead to essentially the next big breakdown, the next big meltdown.
Interesting. Anyway, welcome everyone to the fourth and final day of the 2021 Expats Virtual Financial Summit. We're delighted that you're joining us online today. I'm Helen Berggraf, editor of the American Expat Financial News Journal, which you can find at americanexpatfinance.com, and you can sign up there to receive our weekly bulletins and sometimes breaking news bulletins. Like today's online session, this week's 4-day 2021 Expat Summit represents the collaboration of several organizations and is primarily aimed at Americans living abroad and features some of the world's leading experts on several different aspects of expat finance and life. We and the various experts themselves, I think I'm safe in saying, encourage you to register for the one session that's left in about an hour from now. You're here now, so there's just one left. If you're interested in seeing some of the ones you've missed, they will be available online at www.expatsummit.com eventually, I think. And in the meantime, before we go any further, I have to read this thing that, just to remind you, as you probably already know, that the contents of this presentation do not constitute tax, financial, or legal advice, but are intended as general information only, and as each person's situation is unique and each person should get their own advice. So, today, as I presume you already know, we're lucky enough to have with us Brian Dunhill, who is the founder and CEO of Dunhill Financial, whose presentation is on the subject of themes for Americans abroad investing in 2021. Brian is the founder of Dunhill Financial, which facilitates personalized investment plans for Americans abroad, including younger expats with long-term aspirations. Brian is Belgian-born American-British dual citizen who has been based in Europe since 2013. He's also an advisory committee member at the American Citizens Abroad, and he served 2 years as the president of the American Club in Brussels. Anyway, welcome, Brian. How are you today?
Thanks, Ellen. Wonderful. Wonderful. How are you doing? Wonderful week. Thank you for putting this all together. You must be exhausted and ready for a well-deserved weekend.
Yes, I hope so. Anyway, where are you joining us from?
Well, I'm here in sunny London for once and for all. After a couple frosty weeks, it's starting to get nice out.
Yeah, it's starting to. Yeah, well, I guess that's about. Well, normally I ask people about the snowfall, but there's no snowfall in London, I know, because I'm here too.
All the storms are over in America. It seems Vegas is, I was hearing that all these places that don't normally have snow are getting inundated right now. So I'm glad we're over here instead of over there.
We interviewed somebody from Vancouver who didn't have much. The most snow of anybody we've interviewed so far, I think, was probably in Madison, Wisconsin. So.
As it should be, as it should be.
Yes, I guess. Oh, I see. Okay. So I guess without further ado, well, let me see if I have anything else I'm supposed to be mentioning. I think that's about it. I was just going to say, before I sign off, there's a Q&A session after Brian's talk. So if you're interested in asking him any questions or about something he's talked about or whatever, see the Q&A tab down at the bottom of your screen. You can write your questions there and we'll pick them up. So without any further ado, over to you, Brian.
Thanks so much, Helen.
You're welcome.
Hello, everybody, and welcome. I forgot how loud that is. Sorry about that. So today we're going to be covering a lot of different topics, and I want to make this as fun as possible as we can have on a Friday. We've done several presentations this week. We've had a lot of meetings, so we've saved the best for last right here with all the energy. So please put all your questions, your comments in the comments box. I'm not going to really be filtering them during the actual presentation, but Helen might chime in if she has comments or there's comments from that box. We'll have some nice Q&A at the end where you can jump in and we can interact there. I'm just going to jump right into this whole maze. We have lots of things to talk about, including currencies, FBARs, the IRS, etc. So I'm just going to go right into the middle, but let's start with how we got here.
John Burrow once said, "A man can fail many times, but he isn't a failure until he begins to blame somebody else." Despite these wise words, we are in the age of Trump and Brexit. Therefore, let's start to point fingers.
Most all American expats have had many negative ramifications from the Foreign Account Tax Compliance Act, also known as FATCA. In fact, it might have led to the closing of your brokerage account in the United States, or even your non-US bank telling you to go elsewhere.
So it's Obama's fault, right?
Not exactly. When you follow along with FATCA brought about, it's really introduced ways that American expats could get caught while not declaring taxes, owning PFICs, or even not declaring taxes that were owed.
So if Obama just built a means to catch non-compliant individuals, why did everything change for expats in 2010?
Well, rules from past presidents started to be enforced. Ronald Reagan, beloved president that was in favor of cutting taxes, added a huge tax to American expats with foreign investments with the introduction of PFIC rules, also known as passive foreign investment companies. These were designed to prevent Americans from owning managed vehicles from foreign jurisdictions.
So what about the notorious Nixon?
In 1970, Richard Nixon signed into place the Bank Secrecy Act, and American expats had to report all foreign bank accounts that aggregate to over $10,000 US. They have subsequently never increased this amount to meet inflation growth. If you haven't provided these documents, they can lead towards large fines. All the while, no tax is ever owed on these declarations to the Treasury Department. Until FATCA, Nixon and all subsequent presidents had no means to police the foreign banks and to enforce the rules.
For the sake of pinning the blame for the frustrations behind being an American expat, we blame Abraham Lincoln.
Lincoln may have abolished slavery in the United States, but made any American that moved out of the country de facto slaves, of which no other country other than Eritrea follows the logic, and even Canada has banned them from being able to do so. Abraham Lincoln introduced citizens-based taxation with the first income tax signed on August 5, 1861, and was a measly 3% of income to help fund the North in the Civil War efforts. All of the above culminated in what is now known as the FATCA Accords established by Barack Obama. This law was designed to increase the compliance of U.S. taxpayers that had reporting requirements for financial accounts that were held in foreign jurisdictions. To ensure compliance throughout the chain, the new framework imposed legislation onto both the individual and the financial institutions that service the U.S. persons. This led to the stricter reporting standards and larger penalties being imposed for non-compliance. With the newfound power in place, the FATCA Accords essentially became the international policing force for U.S. persons with foreign accounts and assets. With over 113 countries having signed up to comply with the U.S. FATCA rules, and an additional 200,000 plus institutions having registered with the IRS.
Always odd to hear your own voice on a video, but now we know exactly who we should be blaming and the such. Now we're just going to go through and figure out exactly how we can solve these types of things. But before we get to that, we really should establish that this was a problem that the IRS saw an opportunity to fill a tax hole, and that's where they were able to swallow up that huge tax hole very, very quickly. You'll notice right here that in the early 2000s, there was nearly $2 trillion worth of unreported income from American expats that were abroad. And then it just got larger and larger. The United States went after big companies like UBS. I used to work with UBS when a lot of this went down. And I was in the States where it was nice and boring. But essentially, they destroyed banking secrecy, and it really affected a lot of us American expats, because most of you will know UBS as a retail bank inside of Switzerland, and they had to close down all 52,000 Americans' accounts over there. This is kind of replicated in many other countries to where there are negative ramifications for us American expats, and that's what we're here to do, is to help you find solutions to these negative aspects. But although we were very excited to announce being part of the inaugural group of companies and organizations that are part of the RBT Coalition, which you can find more information at www.rbtcoalition.org, which ACA and AARO are heading up, and Dunhill Financial is a proud member to be part of. The amount of money that came in voluntarily from the introduction of FATCA was so large that we shouldn't expect FATCA to go away. We're hoping more that we can make these things easier. For instance, ACA started with their first initiative of just giving Americans the right to vote abroad. That was way back in the 70s. So you can see how far we've come and how many initiatives we've gone on to try to help everyone. And that's to where FATCA is most likely here to stay. Well, what is FATCA? Well, FATCA, simply put, is a law that states that any foreign institution that's a member that has an American client has to report those American clients back to America. So in other words, we can't hide anything in any foreign country. That means a lot of banks have said, we don't want to deal with these types of individuals. And these individuals are not only people like myself that sound American, walk American, talk American. But if you move into America and you become resident in the United States, even for a short period of time, you end up becoming subject to all of these same rules. And even a green card holder that's moved out of America is still subject to everything just the same as a US citizen until they turn back in their green card. And it doesn't matter how many passports you have. I have multiple passports, and I still have to report everything back to the States. Now, the first thing that you need to be aware of is that any American that lives abroad or even lives in the United States that has accounts abroad, if they go over $10,000 in aggregate, you have to report them back to the Treasury. Now, if you don't make this reporting, you're going to be subject to a lot of fines and a lot of pain. And there's no reason not to report these accounts because it's not to the IRS, it's to the Treasury. There's no taxes due. They just want to know where your money is. Now, the bottom of this are the two very interesting aspects to these FBAR reportings and the things that are constantly asked. Now, at this point in time, they don't require you to disclose Bitcoin accounts or internet poker accounts, but they are examining whether they want to change that. And I would expect them to include them, especially with the popularity of Bitcoins increasing over the course of time. So don't take advantage of that. And I would certainly, near the end of the presentation, I'll talk a little bit about crypto. I would certainly not start investing in crypto just to avoid an FBAR. They're very simple to fill out. If you need help, any of the American Expat tax accountants will be able to help you fill it out or just keep the assets in the States. The last one are foreign pensions. Now, most accountants that I've seen state that you don't need to report a foreign pension because you do not have the access to the information underlying. Now, that's not purely written out in law, or I've never seen it purely written out in law. So if you want to be safe, still include it and just find a high water mark. It's the more conservative way to go. But essentially, the importance, especially if you're in a country like the UK or Canada that has a more modern double taxation agreement, those pensions will act and be viewed just like a retirement account, so you won't have to worry about it. Now, I'm going to start right in the deep end and the negative end of things of what you want to avoid. If you're just moving over here or you've been here for a while, this could be a different thing. If you're just moving over here, just remember, even if somebody pitches you something that is a PFIC, but you're taking the QAF election, it's bad news. It's going to hurt you over the course of time. If you have been here for a while and you happen to have bought a PFIC, now all of a sudden it's trying to unravel that. Taking market dips like we had at the beginning of last year as an opportunity to sell out of these is a great opportunity to minimize the excess taxes that you'll owe. But there's never been a situation that's crossed my desk in which we felt that a PFIC was actually a good investment for a client. Now, what are PFICs? Simply put, it's any time you have a foreign investment that is a collective of any kind. So if you're in Europe, if you have a UCITS structure that's managed in Europe, it's definitely a PFIC. Doesn't matter if it's inside of a portfolio bond or just sold directly on a platform. On top of that, if you have an exchange traded fund that's traded on a foreign exchange, that is also a PFIC. So you can't just buy the S&P 500 on the Frankfurt exchange or the London exchange and think that it will behave just like the one in New York. It will be taxed at a progressive rate, which can be extremely daunting. It might be good for your local taxes, but the better it does, the higher the percentage of tax you'll pay in the United States. And it will be very, very painful when you get out of it. So we always suggest avoid PFICs at all costs. So a lot of people, a lot of American expats will basically say, okay, well, this is too hard to invest. It's too hard to, if I set up an American brokerage account, they close it, saying we don't deal with foreigners. If I go to the local bank, they say I can't open it. We'll give you solutions for those later. But right now we're going to talk about all those people that have what we call in Belgium a brick in their belly. They want to buy real estate at all costs. And we completely understand that because let's be honest, for a lot of our lives, since 1982, interest rates have been going down and down and down, which makes it cheaper to buy real estate. But that's also made the price of real estate go up. For many of you in European countries, you're going to have negative interest rates, or here in the UK, just barely positive. So it is very cheap to buy and service a house. And on top of that, you get some benefits on the US side of things. You still get that $1 million worth of interest that you can deduct on your US taxes, and an extra 100K if you do a home equity line of credit. So that little bit of interest that you are paying, you get to deduct from your taxes. And the capital gains on the US side, you still get that $250,000 deduction per person. So if a married couple owns a house, you can have $500,000 worth of capital gains tax-free income when you sell your primary residence. So there are huge benefits of owning real estate from a tax perspective, but there's some things that you need to consider when you're an expat and buying international property. The first thing, 1031s don't work on international property. Doesn't matter if you're going from a US property to an international property or an international property to another international property, they just don't work. So whenever you sell the property, you have to be ready to realize those gains on your US taxes. Second of all, doesn't matter where you are, you cannot use your money inside of your IRA to buy real estate. The IRS will flag that. They'll go ahead and say, hey, this is illegitimate. They'll make you take the money out. So you have to make a distribution from your IRA and pay the taxes and sometimes the penalties if you're not of age, or if it's over 10,000 US dollars that you're taking out, and you have to go ahead and buy them in your own name. Now, don't think just because you're in a jurisdiction that's not really reporting well with FATCA that you can get away with it, because there's more and more global transparency with these types of things. FATCA's come a long way in the last 10 years, and so regulators are getting better at knowing what's going on. We don't typically like owning foreign real estate inside of a foreign company. Now, a foreign company is more of a corporate structure. So an SCI in France, a Société Civile Immobilière, still works because that's a pass-through entity. But if you have a corporate structure, sometimes those can be damaging. Now, here's where it gets to be the really bad news, and I'll go through a quick example. The house and the mortgage are separate on assets, and the US, the IRS, considers those in dollars, not in the foreign currency. So I'm going to go through a quick example. I'm dreaming for some reason of having one day a nice, beautiful villa down in Tuscany. So I'll use this as an example. And I'm going to just say that real estate is flat. So over here on the left side, buy the villa for 5 million euros. And so the IRS will consider that purchase price to be 5.92 million US dollars. Now, let's just say 10 years from now, that property doesn't appreciate at all. So real estate stays flat, but the euro increases 10% to the US dollar. You'll see that we bought it for 5 million euros, we sold it for 5 million euros, but the IRS, because they're looking at it in US dollars, is considering that we bought it for 5.9 million US dollars and sold it for 6.5 million US dollars. So all of a sudden you have a $592,000 US gain, even though you didn't gain anything in euros. Meanwhile, on the other side, the mortgage in dollar terms increased, but we can't offset that mortgage. So we have to be ready to pay that capital gains tax, even though we didn't really make the money. Why have we not heard about this so much in the expat world? Well, simple. The dollar has been increasing for the last decade, so most people have not had these fictitious gains to the IRS. But since August, that has reverted, and we've started to see the dollar weaken. So take this into consideration before you start buying property, of the longevity that you might own that property, because you might have some fictitious gains in the United States. The famous case was Boris Johnson buying and selling his property here in London, and then all of a sudden having to pay some tax back in the US, which led him to actually give up his US citizenship after he paid that tax. But he was very upset about it. So you need to be aware of that. You need to think about that in your longer term planning and take into account what the currencies could do over the course of time. Social Security, we're going to go straight to the end, and then we'll get back to the portfolios. Lots of countries have totalization agreements. So make sure you keep track of all the places that you've worked. Just because you don't reach their full credit system, like in America, we have 40 credits. That's 10 years worth of work for credits per year. If you work enough hours, which most people do. Now, if you don't reach those 40 credits, but you work in the UK or Europe, you can use the time that you worked over here to make sure that you get a pension, a Social Security in the United States. You have to let Social Security know that. You will be prorated down for the time on each side, which isn't really a problem because you'll still get that Social Security in the foreign country as well, but you will get a payment from both. The nice thing is if you call Jack's office in here in London and you say, hey, I'm entitled to a Social Security check, they will actually send it to your foreign bank account in that foreign currency at no cost. So a much easier way to deal with minimizing your exchange costs and any of your transfer fees. So make sure that you're in contact with Social Security. I find that these departments that are giving you money are much easier to deal with than some of the ones that want to take your money. So make sure you're aware of those types of aspects. Also, when you're planning for your financial for your financial plan, be aware of what's called the WEP, the Windfall Elimination Provision. It's the small print right on the second page of your Social Security statement. It essentially says if you were receiving a foreign pension in the future, that they will reduce your Social Security. There's calculators directly on the Social Security Administration's website so that you can figure out exactly what the WEP would be. For most people, it's a reduction of around $300 to $400. So that gives you just a ballpark to figure that out. But make sure that you calculate that before you start receiving your Social Security, because that might change when you elect to receive your Social Security. Now we get into the true grit of what we're here to talk about, which is where should I bank and where should I invest as a US person? Now we recommend to always use a holding company that's only going to own American instruments. Most of ours are back in the United States, but we have some here in Europe for people that would rather not send money back to the States, that they'd rather be reported in euros or pounds, or that they need a vehicle like an ISA or a SIP, so the retirement accounts here in the UK, and the individual savings accounts that are tax-free here in the UK, then we have to keep them in these jurisdictions. Now, why do we want to keep those assets in American holdings? Well, first, to avoid those PFIC problems. Those are excess taxes back in the States that we don't have to pay. By having American holdings in an American account, we eliminate those. The second one is 1099. A 1099 makes doing your US taxes so easy. You've had some great tax presenters this week on this program that essentially it will shrink the amount of time and therefore the expense of them doing your taxes if you're able to provide them a 1099 instead of having to build those from scratch. The third one is the FBAR. If the account is in the United States, if it's with one of our US carriers, you don't have to do an FBAR filing. One less document to do each year. The fourth one is actually quite significant, especially in a time where markets are all over the place and we don't know how this recession is going to play out. But safety. Banks in America since the 1930s have known exactly how to deal with issues because we have FDIC coverage, SIPC coverage, and the likes. So when Lehman Brothers failed, all their wealth management clients, all the clients that had investments with them, essentially got shifted over to Barclays Wealth Management. Bear Stearns got shifted over to JP Morgan. They didn't lose any of their investments because they're ring-fenced in the United States. Therefore, they're safe. Now, other jurisdictions throughout Europe will remember a few years ago when Cyprus essentially had banking problems and they just took 10% out of all the investment accounts, or out of all the bank accounts. Essentially, European rules are not built on how does it work when an institution fails. They take each failure one at a time, and therefore you're having to trust the politicians. Not going to get political today, but I'll universally just say, I'd rather not trust the politicians. I'd rather have that ring fence. So having that safety to me is a big thing. The last one is fees. Fees. Fees, fees, fees. They're so important. If we can keep the fees down, you're going to make better returns. And everything is cheaper in the investment communities in the States, whether it be the ETFs, whether it be the structuring, whether it be the investment advisors. And on top of that, the platform fees. In Europe, typically a platform is going to charge you 0.35% to just get on the platform. In the US, as you know, most of them are free. Most of the trading fees are free. And that means that we can basically get our money really working for us. So what do we do differently? Now, this is our raison d'etre, is all about currency exposure. And currency exposure is so significant. I don't have to tell any of the expats on this call how currencies are shifting, and that can affect your what your take home is, because you've lived it. You've got some savings back in the States. You've bought a house over here. You've done all these types of things. So you've seen that when the dollar is going down, if you're paid in dollars, you're getting less every single month. So how do you hedge this? Well, there's 4 ways that I won't talk much about: future contracts, forwards, options, and swaps. Those 4 are great things if you have a lump sum of cash in the United States. You know you're buying a property next year. You know you're starting a business next year. You know you're doing something big next year, and you need to hedge that limited time risk for that period of time. So you pay to go ahead and put in that contract. But if we're planning for retirement, it doesn't work so well. So those 4, well, consider those if you've got cash in the States and you want to buy something next year. The last one is natural hedges. Natural hedges are the real difference between what we do in managing our portfolios versus you just buying an index portfolio in the States, just like if you were an American expat. Now, the beginning context of how we're going to look at the world for this example is by looking at the MSCI Global Index. Now, the MSCI Global Index, as you can see, is 57% United States securities. So all we're doing is we're taking all the companies of the world, taking their market cap, and then putting it down based on where what country they're from. So the majority of the world is the United States. About 14% of it is Europe. You can see 3.75% of it is the United Kingdom, and then it goes down the line. Now, if you take a look at your American portfolio, doesn't matter if it's Morgan Stanley, UBS, it doesn't matter if it's Wells Fargo, Goldman Sachs, they all design their portfolios in a very similar way. It's probably going to be 80 to 90% US securities. So that difference between the 57% and the 80 to 90% is what is called natural hedging. This means they bought more US companies because that's reduced your risk in US to foreign currencies. And this is how you get better returns over the course of time. If you reduce your risks, you can perform better over the course of time. Now, if you go into a European manager and you don't tell them that you're American and you ask them to look at their portfolio, you'll probably find that they have closer to 50 or 60% in European securities versus the 14% that it represents in the world. They're doing the exact same thing because the European managers are essentially minimizing that currency risk by owning more euros. So that is what natural hedging is. And let's go into where we think currencies will go in the meantime and why it's important to think about these. Being a bunch of Americans on a Friday, the most fun way to think about currencies is by talking about hamburgers. And The Economist has this tongue-in-cheek economic indicator that's called the Big Mac Index. It's been around since the 1970s. It's a fun way of evaluating PPI, which is the Purchasing Power Index. Now, essentially what they're doing is they're looking at the price of a burger, of a Big Mac, in every single country around the world. And when they look at those, they basically say this is, since it has all these different ingredients in there, this is a good way of being able to monitor what the price of things are around the world. Now, it's not perfect, but it's pretty correlated to PPI, and it's much more fun to talk about. So when we evaluate it, it doesn't matter if we look at developed markets on the left or emerging markets on the right. You'll notice that that black line that's right there in the middle is essentially the US dollar. And you'll notice that most every currency has remained underneath it. So there's not that many overvalued currencies compared to the dollar, but there's a lot of undervalued currencies compared to the dollar. So what happened that made the dollar so expensive? We're just going to go back a decade. Back in those days where, remember, we could socialize in a bar, or that we could have this actually as a seminar instead of a webinar. Back in those days, we actually had 7 strong currencies. We were coming off the financial crisis. And during the financial crisis, believe it or not, even though America kind of led the financial crisis, people flocked to the US dollar as safety. But they also flocked to the Canadian loonie, the Australian dollar, the Swiss franc, Norwegian crown, Swedish crown, and the British pound. These were the safe currencies of the world, where essentially people felt safe with their money. You flash forward to 2014, and we had this giant commodity shock. And that basically meant 2 commodity-rich countries in Canada and Australia fell off that strong weighting. Their currencies dropped significantly because they were so correlated to commodities. Naturally, being here in the UK, Brexit came along, and the pound spent 4 years from 2016 to present, essentially just falling. 40% drop over the course of 4 years. And so we were just left with these 4 strong currencies. And then we had the pandemic, and the pandemic again led to a flight to safety. People want to be in safe currencies during unknown times. And because Sweden, Norway, and Switzerland are such small economies with such small stock markets, a lot of that money flocked into the US dollar. And with that US dollar, essentially came a little bit of a bubble in currencies. That went on until August. And in August, essentially the dollar started to come down. Nothing political, it just started to normalize again. What goes up comes down eventually. And that's where we've started to see, as commodities rise, Australian dollars and Canadian loonies coming up. And now that we have Brexit taking course, we're going to have a weird couple of years with the pound, but it can finally start to build up some momentum, etc. So the natural hedging to where you're going to retire becomes more important than it was in the last decade. In the last decade, if you would have ignored all of those rules of invest in your local currency, if you would have just bought the S&P 500 and forgotten about it, you would have done great. But now, if we go into a 10-year period where the dollar goes into weakness, which we've got to be honest, before the dollar went into strength in 2010, we had 40 years between the ECU and the euro where the dollar was going down and the euro or ECU was going up after Nixon got off the gold standard. So these currency movements can last a lot longer than we might like them to. And so we have to plan with that in mind. If you're going to retire in the States, you can have a US-centric portfolio. If you're going to retire in Europe, you should have a Euro-centric portfolio. Here in the UK, you should have a GBP-centric portfolio. So what do? Well, we build portfolios. We structure them on platforms. Here in the UK, we can build ISAs and SIPs. We make sure that they're all US compliant in every single way. On top of that, we make sure that every investment inside of there is MiFID compliant for everybody in Europe. Those are the European rules, which basically says we shouldn't have any mutual funds inside of them. While we haven't heard of any European countries going after those or taxing them in a negative way, what we don't want to do is we don't want to build a huge capital gain inside of our portfolio and then have the Italian regulator show up and say, you need to sell that right away and have to realize those taxes when you're having your best year income-wise, because then you'll be in the highest tax bracket. So we'd rather set it up in a structure that the European regulators will look at it and they'll say, not a problem. Here in the UK, you need to make sure that it's HMRC compliant. So it's the revenue services. They have a list of funds that we're allowed to buy in the US. So you'll find a lot of times we don't have the cheapest fund in our portfolio, but that means we're paying 20% tax instead of your regular tax rate, which could be up to 45%. So very important things to think of, not just American compliance, but your local country's compliance. Our portfolios are essentially designed in US dollars, euros, and pounds. For those of you down in Australia, we do have a line. It's just not public at this point in time. So drop us an email and we'd be happy to share you those portfolios. For our other global clients, most of you, Middle East, Asia, you end up in portfolios that are very much like the US dollar portfolios with a little bit of a mix. But contact us and we'll help guide you through those. We build them in 6 different risk levels. You'll see that link. You can go directly to our website and you can actually find all of these listed right there, from conservative all the way to aggressive, depending on what your needs and goals are for each of them. And you can see, depending on which portfolio you select, essentially the amount of US equities is going to shift dramatically. In the unoriginal way of using our burgundy backdrop, you can see that burgundy is the amount of US equities that we have in that moderate growth portfolio for those different currencies and how we manage that risk in the underlying. This is the page from our website. If you click on any of those portfolios, you'll get our 2-pagers and a full description, including our detailed analysis of what we're doing at this point in time in the portfolio. And you'll also have the chance to take our risk questionnaire, which will give you a simple number to help you decide which portfolio is best for you, or otherwise you can always contact us by email or give us a call. This is our approach to investing.
In 2007, Warren Buffett made a bet of $1 million that an index fund would outperform a collection of hedge funds over the course of 10 years. And of course, he won. With that said, the market often represents opportunities and risks that are hard to ignore. So how can I have my cake and eat it too?
What is core? The core of your portfolio is a bit like a tree trunk. Having a strong trunk will allow the tree to weather a number of storms and in turn continue to grow. This analogy does not only apply to trees in the forest, but can also be applied to your portfolios. A well-diversified portfolio will have a number of strong core positions that act as the trunk of the portfolio.
What are the satellites? Sometimes an opportunity in an individual stock, currency, or other investment presents itself, or even excluding a certain portion offers an opportunity in the marketplace. The key towards having good satellites is that they remain smaller positions of the overall portfolio, so that you don't lose your overall diversification. At Dunhill Financial, we keep all our aggregate satellite positions to under 20% of the portfolio at all times. And in normal times, we would prefer to have no satellites. I miss those normal times.
I miss those normal times too. I'm going to power through these last couple of slides because I know that Helen wanted to keep me contained. Sorry, like I said, we're going to have a fun time today. So what are we doing inside of our portfolios? 80% of our portfolio is going to be made up of that core. So those are really the, we don't use the S&P 500. We prefer to use the KLD 400, which is the socially responsible index. In most everything we do, we're in a 5-year program to try to be fully socially responsible and understand how the social impact of our portfolios will be. Not only has that been the right thing to do, but we've ended up performing a lot better than if we would have just ignored social responsibility. But 80% of our portfolio is going to fall into those core positions that we're going to hold good times and bad. Up to 20% can actually be in those satellite positions where we're making decisions. So what do I want to accomplish with this economic part at the end? Well, right now, there's an independence. The markets are separate from the economy. And that is something that's strange to try to explain. We're not going to think about this time being different. And I want you to understand where our head's at for 2021, because things are quite strange. We all know 2020 was such a weird, odd year that we're glad to have behind us. I don't think I need to walk through all those steps, especially not with all the COVID updates. We know that everything to do with the recovery has to do with COVID. And the typical analyst from the beginning last year, we were basically measuring the recovery being based on a 2.5-year timeline. Again, going back to the Mark Twain quote, But, you know, history doesn't repeat itself, but it sure does rhyme. We basically just said the Spanish flu took 2.5 years to dissipate. Here we are a year later, and you look at what most analysts are saying. They're saying this summer we should get to some normality because of vaccination. By the end of the year, we should have regional blocks where people can travel around, but it won't be until mid-2022 that we can expect to have emerging markets and supply chains all back to normal, to where essentially life is in full recovery. Now, if that ends up being sooner, naturally, we're going to have a much better performing market than we have right now. If it becomes later, we might have a pullback, i.e. we might turn into a W recovery, whereas now we are not in a V recovery. The stock market is in a V, which means that the market went down, especially in March. We recovered fully, and now we've actually gone much, much higher. We are actually in what's called a K. Now, a K, this is not what we're rooting for. This is what the reality is. In a K recovery, what happens is everybody goes down, the economy and the stock market. The rich got richer, i.e. the stock market improved. The poor got poorer, making that K. Essentially, if you run a small store, if you run a restaurant, etc., or you have a friend that has one of those, please make sure to go support them, because they're having a very hard time with this. But stocks are doing quite well. Not all stocks. And that's what this chart really shows. I'm going to play it again just because it's fun. Essentially, most all of our performance in the United States came from selective companies. The S&P 500 looked like it had an unbelievable year in 2020, but was it really that great of a year? 23% of it is made up of 5 companies: Facebook, Amazon, Apple, Netflix, and Google, the FANGs. Now, if we go ahead and we even weight the S&P 500, and we just said every company represents 1/500th of it, it was barely positive. When we market cap weight it, it had an amazing year. And it's not hard to say that a company like Amazon, that's in logistics and in the cloud business did extremely well because everybody's working remotely. And with most retailers being closed, the amount of deliveries, it grew extremely high. So anybody that's saying Amazon is really expensive because it doubled, well, their revenues doubled, so therefore their stock price doubled. So it had to have been really expensive last year. You look at Apple and Facebook, who just had their earnings a couple days ago, and they were tremendous, well above analyst estimates. These companies, these technology companies, have done really great. And on top of that, you have a Biden administration that's not backing off on the thought of breaking these companies up. And again, back on that theme, that Mark Twain theme, if these companies get broken up, they will be worth more as pieces than they are in one grouping. And so therefore, we would be excited to see those broken up. I think most of those companies would be excited to have them broken up, just like Rockefeller was excited to see Standard Oil broken up, and AT&T was worth way more as pieces than they were as one big conglomerate. So this, to me, says that the tech scene in the United States has a lot of room to move, but they're also growing their revenues in big ways. We would expect that essentially when GDP comes back and we start to see growth, sorry, I'm going to skip a few and I'm going to come back. Essentially, we would look at those sectors that have done horribly finally recovering. So we would expect real estate, hospitality, tourism, and leisure to do really well. Now, real estate on the residential side has done really well, especially out in the suburbs. But commercial real estate has really struggled, as you can only expect. At some point, they're going to hit a bottom. We have not started buying into any of these sectors, and we won't until we know that we have conviction that we're getting into a recovery phase. We have started to buy in the green energy industry, and this is mostly on the buildup of initiatives by most governments to try to do Keynesian economics, which is spend your way out of these problems, and invest a lot of money into green energy. We've also had huge initiatives from BlackRock, which was just announced today, that they're going to be pushing companies to be more green and more sustainable. So when you have 1.9 trillion from the government, when you have the biggest asset managers pushing people to do the right things, it's no surprise that it's the first time in history that oil prices are increasing, but so is investment in green energy. And that's where those were some of our best performers last year. Now, that is, like I said, mostly because of the expansion of the government's balance sheet. And when the central bank increases their balance sheet by so much, we shouldn't be nervous about the stock market. We shouldn't be so nervous even about the bond market. We should be petrified about currency markets. So this is to where when we're talking to our clients, we're not sitting there saying, this is the right currency, that's the wrong currency, or anything else. We're saying we want to be diversified. We don't want cash sitting in the bank because that cash could be in the wrong currency, and we don't know who's going to win this whole aspect. What did we get right last year? Last year was our biggest shift in our satellites in our positions. And most of them were obvious moves right there at the beginning of the year. We sold out of all of our real estate. We were very happy to get out of them because we still don't know how real estate's going to behave. And I find them fascinating conversations that we have on a weekly basis to where the recovery could be and where the bottom could be. But the landscape of cities is going to be completely different post-COVID. And therefore, there's going to be some big opportunities there, but we were happy to be out of it for this point. We made our biggest increases into technology stocks, not just in the United States with the FANGs, but also with the BATs over in China, Baidu, Alibaba, and Tencent, and e-commerce platforms, which I'll talk a little bit about soon. For the first time in my 20-year career, we've added gold and silver to our portfolio. I've always figured it was a useless commodity that doesn't even keep up with inflation, which is true since the 1970s. But as a hedge against big currency movements, it is actually a great component in the portfolios. So we were happy to have it in there and to get exposure to that. Our eggs position, we've just gotten rid of it, but we were happy to have it, and we were happy to have a hedge that didn't work. Eggs are, it's a funny thing. You have 110,000 items in a grocery store, and the item that grows lockstep with inflation, that grows the fastest when it comes to inflation are blueberries. Prices go up on everything, blueberries go up exponentially higher. The item that never grows with inflation, it's inflation proof, are potato chips. Cheapest item in the grocery store, never shifts. It's always 99 cents for the most part for those little bags. So the only item that grows lockstep with inflation are eggs. And this is where, when we're nervous about inflation, we like to buy egg farms. Kind of a weird type of thing. Makes for a lot of horrible, corny jokes, which I'll welcome you to add yours to the comments box. But we're not predicting inflation even now, but we are fearful that if inflation comes, it could come in fast. And therefore, eggs are the perfect way to do that. And I'm not talking about filling up your fridge with eggs, by the way. I'm talking about buying exposure through those farms. Now, we've also increased our currency exposure in big ways and in different ways. This is the first time in my life you noticed that last year, Donald Trump, I promised you I wasn't going to be political. This isn't political. He stopped talking about China manipulating currencies about halfway through last year. Well, that's because the dollar started going down and the renminbi, which is the Chinese yuan, started going up. So it's the first time in our lives that we're really seeing the Chinese yuan, i.e. the renminbi, going up in value. And we are anticipating that could continue to happen. We know during the financial crisis in around 2011, China was making a big push to get a seat at the table to be one of the world's world currencies. We're not saying that they're trying to dislodge America or anything else. Still, 80% of transactions are done in US dollars in some way, shape, or form. But that could dissipate, and that could bring great opportunities for investment in China. But there's great risks going forward as well. So we have to be cognizant of that. We're nearly at the end. We've got a few things that have jumped out, especially in the last couple of weeks. And there's a lot of people talking about valuations of stock markets, that we're getting back to 2001 levels, et cetera. etc. I'm going to take the Yale economist, Professor Schiller's vantage point. Now, Professor Schiller, he believes in a different way of evaluating PE, which is basically to take an inflation-adjusted 10-year moving average. And that is what the Schiller PE looks like. Now, you'll notice that when we get to 2001, we got to extremely high levels, and we're starting to move up to those levels. We're nowhere close to those actual levels, but we are expensive. But if you look at any of Schiller's newer reports, he will say that you need to adjust stock prices to bond values. Is that perfect? Absolutely not. But does it get valuations more in line with what we want them to be? Absolutely. And that's to where we still have a long-term view that stocks are not too overvalued to invest in, but we need to make sure that we're being selective. We need to stay away from certain areas that are definite bubbles. You heard me talking with Helen at the beginning about the GameStop debacle. We had the Hertz debacle last year. We had essentially all these SPACs that are coming on and IPOs that we know very little about. We're staying away from all of that. Those are the noise that scares me, that have remnants of the Joseph Kennedy, Jesse Livermore, and Michael Lewis quotes of yesteryear. We want good companies that give solid earnings, and especially to think about companies that we can add to the portfolio when we get to a full recovery of the economy, that are devalued but will be safe to grow. And that will get us through these types of things. The last thing I promised to cover was cryptocurrencies and Bitcoin. Now, I told you earlier, this is right now a way to avoid reporting something on your FBAR. Probably not for long. We've chosen not to take part in the cryptocurrency movement at all, because we can't find any value in it. And even more so, we're afraid that if a country cannot continue to write more in their currency, they're just going to ban cryptocurrencies. This has happened in China, South Korea, many other countries, that they just don't want people to usurp their currency and put it into another. So the minute this starts actually pulling money out of US dollars or pounds, et cetera, they'll just ban it. They won't need any reasons for it. They'll just literally say it's banned. Now, I don't love that. I'd prefer to have a currency in which we knew exactly what they could do, that they couldn't continue printing excess currency. So as an economist, I do love the thought of a cryptocurrency. It's the actual mechanism use of how do you value it that becomes very hard, and why we've seen huge fluctuations in it. So how have we been playing into this cryptocurrency game without actually buying cryptocurrencies? Well, it's simple. We've used the same premise from back in the 1840s. In the 1840s, you had the gold rush out to San Francisco. All these gold miners went out there to try to make their millions. And one man, Levi Strauss, went out there and sold them equipment, including jeans. To this day, Levi's is one of the biggest companies in the United States because they sold the equipment. Whereas I can't name one gold miner that made it big out there. There might have been some, but most of them just went out there and worked and worked and worked and worked. So essentially, in that parallel, what are we looking at this day and age? Well, we're looking at companies like PayPal and Square. PayPal and Square are companies that we can buy on the indexes that essentially are making money every single time on the margins that somebody's trading cryptocurrencies, no matter whether it's going up or down in value. And so we don't have to worry about whether it's a boom or bust. All we have to do is we have to consider that Levi's and now PayPal are making money on that segment. So what should you be doing when you're looking for a financial advisory company or an asset manager to take care of your investments? Well, we put together 7 questions that are the golden questions that you should be asking. And you should ask to any of them. First of all, are they fiduciaries? i.e., are they acting in your best interest? We believe that you should only work with a fiduciary. We are a fiduciary. We're set up under as a registered investment advisor in the States. So we always have to put the client's interest ahead of our own. The second one falls into that same premise, which is, can we receive any commissions from anybody other than the client? And a broker-dealer, so the Merrill Lynch's, Goldman Sachs, et cetera, they can receive those types of commissions. And if they're receiving one fee for one product and another fee for another client, a product, you don't know if they're selling you that product because it's the best thing for you or if it's the best thing for them. So that's why we like to keep everything on a fee-only basis so that you always know that we're on the same side of the table as you. Fees come into the big question. And what we found was when we evaluated 20 of the different firms over here in Europe that are duly registered between the United States and Europe, that they run from around 50 basis points. Here it says 35 basis points, but I believe it's 50 actually, all the way up to 2.8%. I don't know how you can make money after the financial advisory companies charging you nearly 3%. The average around there is 1.24% for the different firms. Essentially that gives you a good scope of what those are charging. Now we have two different segments. We have our asset management, and we have our financial planning. And so if you're just struggling setting up an account, if you're a youngster that's just starting out in your first job and you just need to start sending money in on a monthly basis, we have a product through you for our robo-advisor, and we only charge 50 basis for it. So it just gets you on the platform, gets you investing, gets you setting up on that monthly basis. If you're needing somebody that's more helping you with the estate planning, et cetera, we come in at 1%, and then we lower it based on when you get to certain thresholds. So there's programs for just about everybody. So you have no excuse about getting started. You always have an access point. And even if you have another financial advisor, most all of our portfolios are available for them to purchase at that 50 basis points on an institutional basis. You want to make sure that they're regulated by the SEC. So you can find this on Broker Check, which is the last question. If they're not regulated by the SEC, they can't sell US securities. You also want to make sure they're regulated in Europe or the UK. We have a sister organization that we go ahead and do our regulation through so that we can solicit everything over here. If we're not doing that, that means that we're not regulated and we're not allowed to solicit clients over here. You get a lot of firms back in the United States. They call up, they give their seminars over in Europe. They say they're fully qualified. They're not even legally allowed to talk to you and solicit from over there because they're not regulated over here. And therefore you'd have no ability to go after damages if they gave you incorrect advice. You also want to make sure they don't sell PFICs. If they're advertising that they're selling PFICs, you want to walk the other way because those can be very damaging to your portfolio. And while past performance is not indicative of future returns, essentially you want to make sure that you know the past views on those types of customers or those types of firms and see what those past regulatory credits are. You can look into my entire history of 20 years in the business, and you'll see that we have a squeaky clean record when it comes to complaints, bankruptcies, or anything of the such. We don't have any, and that's the type of firm you want to be looking at. A couple resources, and then we'll start jumping into the Q&As. American Citizens Abroad, like I said, we've got this RBT coalition that's going together. Their website is full of great aspects, including links if you can't get a U.S. bank account, that you can actually get a free account at the State Department Federal Credit Union through ACA. So great resources. Mary Louise is our actual lobbyist in DC. So she's talking to members of Congress and the Senate about any of these changes that we're trying to advocate for. So I'd encourage all of you to join and partake in everything that they have. You can get a free copy of our American Expat Guide. It's about 25 pages. It slows down how I talk. It breaks down all of these different concepts into easy bits. We give a outside resource on views on PFICs, but before you take my word on PFICs, I'm not a tax accountant. Just Google it. I've never found an accountant that's promoted them. You've also got the US Expat Directory. which is a list of different qualified professionals that deal with American expats. You might need an immigration attorney, you might need an accountant, you might need a lawyer. So it's a great resource to utilize. Broker check, great way to look into the records of any of these firms and any of these individuals. And you'll want to make sure that you use the double taxation treaties for any country that you're in. And on the IRS website, you can get synopses and the full list of those double taxation agreements. A few of our backgrounds, and then you see our team. And I'm sorry, I totally went over on time. So Helen, if you want to join me back, we can try to field some of these questions.
Yeah, we have so many questions. It's going to be hard. And I think as they've come in, you've answered some of them. I mean, the one question that a lot of people asked was your fee schedule, but it's on your website. Is that right?
Yes, it's under our ADV Part 2. But like I said, it's very simple. If you're just looking for investment advice and you just want to set up an account, you have, say, a $50,000 IRA back in the States that they're kicking you out, and you just need some place to place it and you don't need any other investment advice, it's 0.5% per year. We charge it quarterly in the account, no upfront fees, no closing fees if you decide to leave. If you're looking for financial planning, it's 1% and then it goes down. But right there in our ADV Part 2, and it gives you the full breakdown of the 4 different programs that we have.
Okay. There are some younger, there's somebody here who says they're just 20 years old and I want to start investing. Would you be able to help those sorts of young investors?
Absolutely. Anybody that's doing a monthly contribution into the account, we have a 0 minimum. So they can start from 0 and they can send in, our carrier over in the United States will take as little as $50 a month. And we love helping out people that are just getting started. We know it's counterintuitive to making a profit, but I find some of them to be the most enjoyable people to work with because, yeah, they're just getting off the ground. And we all had to start someplace.
No, but that is good because it's, yeah. And I have to say, I did like the story about the blueberries and the potato chips and the eggs. I have never heard that
hungry. I got some blueberries in my fridge. You know, I can toss them.
Okay, let's see. Can you name some brokerages that allow U.S. expats to not have to keep our investments in brokerage accounts in the U.S.?
The brokerage accounts, every single one that holds assets are the broker dealers. So a registered investment advisor is the one that gives the advice. Now, the big one that's still allowing people to open accounts here in the UK and throughout Europe is Interactive Brokers.
Yeah, someone asked about them. Somebody said, are there any catches to working with them? Someone asks.
Yes. Now, Interactive Brokers has an interpretation of MiFID, which is the European rule, that essentially US exchange traded funds, ETFs, are not allowed to be purchased in their accounts. So Interactive Brokers ends up being a great place that you can open an account in many, many countries that we can't with other brokerages. But essentially, they'll only allow you to buy individual stocks and individual bonds. So it works for somebody that has a high net worth, has 500,000, $1 million, and they can own 30 or 40 securities in there. But if you're the smaller investor that's just getting started and you need ETFs to get the diversification, it can be a little bit damning for you. We have 2 other platforms that we utilize, but you have to go through a financial advisor to access them. One of them is Trade PMR, who custodies through Wells Fargo. That's one of our big ones for here in the UK and Belgium, the Netherlands, and Germany. Essentially, they're a very low-cost solution that helps us in being able to use those local addresses and meet all those qualifications. Their interpretation of MiFID is that we can buy the ETFs. The other one is a European solution called Premium. And Premium is a wonderful solution because we're able to get it into euros or pounds. We're able to use the ISAs and the SIPs here in the UK. So all of a sudden, somebody can use the local programs, but they make sure that it's US compliant or that they can move back to the US with it. And those programs, again, they let us buy those ETFs. So,
okay. Somebody said, if you don't know where you're going to retire, I'm in my 20s, he says, how can you best plan your investments for retirement?
It's a wonderful question because, well, we should all have an open door at where we're going to end up one day. Now, I like to use the analogy that if I'm jumping on a sailing boat from London and I know I'm going to the United States, but I don't know if I'm going to Miami or up to New York, where am I going to sail? Straight towards North Carolina. Because that means I'm going to decide one day later on down the line. But if I sail all the way to New York and then I have to go all the way down to Miami, I'm covering twice the distance. But if I go towards North Carolina and halfway there, I decide, I'm definitely going up to New York. Yeah, I've covered a little bit more distance, but nowhere near twice the distance. So we do the same thing for somebody that's, let's say they live in Europe. They don't know if they're going to retire in Europe or if they're going to go back to the United States. Instead of looking at that 90% portfolio that's US dollars or the 50% in euros, we strike it someplace in the middle. And you keep talking about it, you keep factoring it, and as we get closer and closer, we veer towards one or the other. Mm-hmm. It's an easier time to make those decisions now because with a weaker US dollar, having a heavier position in euros is a calculated decision versus trying to essentially conjure up which one we want to have.
Okay. Can I fund an IRA during my expat years?
That's a wonderful question, and it's mostly a tax question. The answer for the most part is yes, you can, but you need to make sure that when you do your tax elections that you're doing them correctly. Now, if you're in a high tax jurisdiction, essentially, the main thing is that you're going to want to take the foreign earned income off your equation, and you basically take the IRA deduction, then you calculate the taxes you paid in the foreign jurisdiction, and you apply it back to the United States. So you still end up paying no tax, but you put the money away into your IRA. The key question is where you think you're going to end up being, not can I put money into an IRA? Because there's certain jurisdictions like, for instance, Germany is the one here in Europe, where in Spain, Hong Kong, they're all kind of in that same basket, that it's not so advantageous to take money out of an IRA. They consider it regular income. So if you're definitely moving back to the States, it's worth spending the time putting the money into the IRA and doing that little bit extra to make sure your taxes are correct. You can even look at doing a backdoor Roth, which you can find articles on our website about doing a backdoor Roth to get the money from tax deferred to tax free. Again, don't go through that if you're going to retire someplace that doesn't recognize a Roth IRA. So all key components in building that financial plan. But the simple answer to your question is yes, you can. It's just make sure that you follow those steps.
Wow, that's some answer. And things can always change at any point, can't they? I mean, that's the other thing. So
absolutely.
You have to constantly be reviewing what you've done and whether it still is relevant, right?
The main aspects with these double taxation treaties is that the majority of countries are still leaning on DTAs from back in the 70s or early 80s. And yet things like Roth IRAs didn't come out until the 90s. So essentially they're not written into the rules. And so therefore, with there being a minority of Americans abroad, most DTAs weren't really written for you and I. They were written for the big corporations to do big business. Sorry to burst our bubbles, but sometimes our politicians work for other people's interest. So having that in mind, we want to think about it based on what we currently have and hope that the situation improves. But we don't want to sit there and spend tax money on putting ourselves in something that hasn't come to fruition.
Wow, that's interesting. Can I own an ISA as an American?
Absolutely, and we have an ISA program. We're one of a handful of firms that has an ISA program. Now, there's goods and bads of that. This means that let's just go back to the old person that asked the question, the 20-year-old that said, "How can I get started?" We're never going to promote our ISA to a 20-year-old that's just getting started, because the problem with the FCA's view on ISAs for Americans is that you can only own European funds in there, and UK funds in there. And so therefore, our ISAs are made up of all individual stocks. That's the only way that we construct our ISAs. So they're not as diversified as we would want them to be for somebody starting out. Now, if somebody has a large portfolio, a large pension, or whatever it might be, and then they're coming along and putting away 20,000 pounds into their ISA, then the two can complement each other, and we don't mind the lack of diversification. If somebody has a large cash ISA, we've brought a lot of those in just to get them invested, and those have worked out great, but it's not a perfect solution. Now, you've got to remember, you'll avoid all the tax here in the UK, but you'll still have to pay the tax in the US. So we'll still get you the 1099. So it's, again, you're lowering your tax, but it's not going tax-free, and you don't have that same flexibility as you would in just a regular investment account. So just like the IRA question, yes, we can accomplish most everything you want, but you want to make sure that it meets the parameters of your financial plan.
And that there isn't some other alternative that would be better, right?
The alternative for most of our smaller clients is put it in a taxable account, and make sure that we don't turn over the portfolio too much to where we won't have capital gains. That's the easiest way to minimize our taxes. And we've got to remember that taxes are the tail, they're not the dog. If we have large tax bills, it's because we made a lot of money. So we shouldn't complain about that, and we shouldn't just build our investments only on tax determinations.
Okay. Somebody says, do you have clients who are US expats living in Austria? And do you understand the estate planning issues involving the two countries?
So yeah, we do have lots of clients all over Europe. And yes, there's many things that are changing when it comes to the estate planning world, especially the US side. It's looking like we're having bigger changes. The European side, it's a little bit harder to do the gifting and the likes. We are actually doing a webinar next Wednesday, I believe, with one of our friends who's an estate planning attorney, and we're going to be talking about just those issues. So if you go to Eventbrite, you can see the list of all of our events that are coming up this year. And Guillaume and I will be having a conversation next Wednesday at 2:30.
Okay, we try to keep your events on our website too, on the events page, because we know there's interest. Let's see what we have here. Somebody said, are ETFs for gold investments treated as PIFICs?
Oh, if the ETF is in the US, if you buy the NYSE's GLD is the symbol that we use, then that is not a PFIC. But if you buy, say, UBS's ETF over here in Switzerland, then yes, it will totally be considered a PFIC. So the easiest way to do it is just buy it on the New York Stock Exchange, buy it in the United States. The hard way to avoid the PFIC issue is to buy raw gold. I don't ever recommend that because you have to find someplace to store it. You have to find somebody to sell it to, et cetera, et cetera. And we've had some clients that have had experiences like that it's been a nightmare for them to get rid of their gold. So I would just go with having it in the US.
In an ETF?
Exactly.
Okay. I think we're getting just a couple more. What do I do with my foreign pension if I move back to the US?
Oh, that's a wonderful question. I love that question. Now, because
it affects a lot of people, I think, doesn't it?
Most definitely. And these laws are evolving. You know, we love to bash on the Commission, the European Commission, but they're doing a tremendous job of moving things forward in a unified way. The US is probably 20, 30 years ahead of the UK when it comes to the financial industry. The UK is probably 10 or 20 years ahead of Europe. In the UK, it's simple. You roll over your defined benefit or your SIP into one of our US compliant ones, mostly to make it so that it's US centric, and we can invest it the same way as your other assets, and we can still manage it when it's back on the US side. That's for here in the UK because they're 10 to 20 years ahead of Europe. Now in Europe, the law is that you can transfer across borders when it comes to those pensions. The application is different from the law. I have not found one carrier that for a good price transfers over and not a million headaches transfers over those pensions. If somebody on this call has one, please call me. I would love to hear it. I'd love to be proved wrong. We're watching that space. And the main thing is cost on that. We're used to 401ks being able to roll over into IRAs since 2005 with the Retirement Act, where basically it's seamless. There's no cost to it. And it makes US carriers so competitive. And we're spoiled by that in America. That's not what it is in Europe. They make it a nightmare to get money out, and they make it expensive. So as we get more and more competitive, I'd expect that we'd be able to get those to be able to be shifted into more other European collectives. So right now, with most all of our clients, the main aspect of it is that we just keep those on the balance sheet, we keep track of them, and we hope that better products will come over the course of time that will adapt to the current laws that the European Commission has put in place.
Well, here's another related one. Should I opt out of foreign pension contributions?
It's a little bit of a loaded question because it depends on which country you're in. So I'm going to divert into a new question, which is when you do have a foreign pension, and for that person, just contact me, and based on what country you're in, we'll be able to help you adopt it. Most people, we would always say, make sure to be part of your pension scheme. But the main thing is when you're contributing to a pension, make sure that you're actually putting it on your taxes as income in the United States. Because if you don't put it down as income, when you actually cash in the pension at the end, you're going to lose all of those credits, and therefore you're going to have to essentially pay tax on that distribution. Your accountant should be able to walk you through that. If they can't, just get in contact with us. We can have a conversation with your accountant and make sure that you're not in the wrong place on that. But you want to make sure that that pension doesn't get taxed twice because you miscategorized it over the course of all of the earlier years.
You just said, just call me. You don't give free advice over the phone to people, I'm guessing.
Yeah,
well, I mean, you have to.
So any friends of
somebody asked this question.
Any of your friends, any of the people on this call, essentially will offer them a free 15-minute consultation, and otherwise they can go through the website and they can book a paid-for consultation if they need something longer to discuss their situation. What
is a basic conversation, Ron?
So I think it's 25 euros for 30 minutes and 50 euros for an hour. I think it's someplace in that ballpark.
Yeah.
But if you drop an email to Isa, she'll be able to set you up with those exact.
Okay, well, that's good to know. Last question: where can I best deposit or cash my U.S. stimulus check?
Wonderful question. Wonderful question.
Well, I think people are getting them now, or they should be.
I know it's only taken a while. So when I was talking about American citizens abroad, if you don't have an American account in any way, shape, or form, all of our clients that have accounts at Trade PMR, we can send them straight over to Gainesville. They can deposit them, no problem. They can add them to their investment account, or they can take out the distribution.
You have to post them back to America then.
Exactly.
Okay.
Come on. This is the American government here. We're still back in the 1980s. Yeah. Now, if you don't have an account with us and you just want a banking relationship through American Citizens Abroad, you can sign up with them and they can introduce you to the State Department Federal Credit Union. You set up a bank account with them. Doesn't matter where you live in the world. Naturally, the State Department Federal Credit Union is used to all these dignitaries that live in every country around the world. So I don't care where you live, they'll be able to set up an account for you, a U.S. bank account, and then you'll be able to deposit that stimulus check there.
But that's just for one check. But presumably there are people who would just like to get the check into their bank account, but they don't, their local bank account.
Most foreign banks will allow you to deposit the check.
But
they
with
will
a high
charge you through the nose to do so.
Yes.
And then again for the currencies. So that's to where even if you're just setting it up for the one stimulus check, I get the impression, first of all, that hopefully you'll get a second stimulus check. And more importantly, that one day you will need a U.S. bank account for something, and therefore it won't be lost on just doing it for one transaction.
Somebody just said mobile deposit form, the stimulus check worked perfectly with the State Department account.
Perfect. I like to hear
there
that.
you go. So that's a bit of information. Anyway, we're quite late now, so I'm just going to say thank you so much for that. That was really great. And anybody who wants to see our last speaker, that will be in about a half an hour now. That will be Rebecca Lammers from the Democrats abroad here in London. So thanks so much, Brian. That was really, really amazing.
Thank you. Thank you for hosting this entire week. Rebecca is always phenomenal. She's full of information. So I will join you over there. Everybody, feel free to drop me an email if you have any additional questions that we didn't answer. Sorry, I ran way over. It's the American spirit in me. Have a wonderful weekend, and we'll see you all soon.
Okay, take care. Goodbye.